2016 has shown interesting price moves as a result of a strong El Niño. And as 2016 draws to a close, we are once again looking ahead to the coming year. We've just published our Agri Commodity Outlook for 2017, which includes our price forecasts, as well as supply and demand projections for soft commodities and livestock products. In this short video, Rabobank's Agri Commodities Markets Research team would like to present some of the report's highlights. The macro environment and currency volatility will remain key price drivers in 2017, and so will Chinese sales of the commodities out of the country's national reserve, which will heavily impact the trade flows to the largest global commodity importer.
There's no hiding the heavy supply situation underlying the wheat complex, with excellent 2016 growing conditions driving global stocks to record levels. As a consequence, prices are currently close to multi-year lows across both the CBOT and MATIF exchanges. This is one of the factors that will drive record demand in the coming year. On the trade side, we can anticipate an even stronger US return to the export market in 2016-17, capturing market share from the EU, which fades away following a poor 2016 harvest. The Black Sea will see another strong production year in 2017, after a record this year with expanding acreage in the region. Taking into account more normal 2017 growing conditions across the globe, we expect a 1% decline in global production, which will see global stocks nearing a plateau. This means prolonged pressure for prices, although risk remains stacked towards the upside in the form of weather, currency swings, and shifts in fund appetite. We forecast CBOT wheat futures to trend marginally higher through 2017 as demand strength sets in. However, they're set to remain below $5 per bushel without a significant erosion in global stock levels.
Record US soybean yields are providing sufficient supplies for the next months, but let's not underestimate global demand, which in the past years often exceeded initial expectations. Therefore, South American crops in 2017 will be crucial. The soybean acreage in Argentina is declining as farmers switch to more profitable grains. Meanwhile, in Brazil, the strong area expansion of the last years is significantly slowing. This, combined with trend yields, will result in record South American crops. But this record is also needed to meet the global needs. Any potential weather issues can easily drive soybean prices substantially higher. US plantings in spring 2017 are another important factor to watch. We expect the overall US acreage of the three major crops, soybeans, corn and wheat, to decline by about 2 million acres. And even though soybean will benefit from the switch in the US from corn to soybeans, the acreage increase of soybeans overall will not be anywhere large enough to allow the US production to reach the 2016 record, just because yields are unlikely to return to those perfectly high levels we had this year. We forecast Chicago Board of Trade soybeans to trade between $10 and $11 per bushel, with more upside than downside potential.
2016 has been a very interesting year for sugar and coffee, as speculators built record net long positions in these commodities. Much of the initial support came from an appreciating Brazilian real, as Brazil is by far the largest producer of both sugar and coffee. But going forward, the influence of the real will likely be lower, as declining implied volatility points to a more stable currency. In addition, sugar is trading 4 cents above the ethanol parity. This means that the small fluctuations in the Brazilian real have less of an impact on sugar production. Two consecutive large deficits in the sugar market mean that sugar prices will have to remain well above the ethanol parity in Brazil in order to avoid much gain going into ethanol production. They also need to stay above the cost of production in the EU peat belt in order to encourage planting decisions and export later in 2017. With this in mind, we believe that non-commercial profit-taking may drive prices below 20 cents towards the end of 2017, but without that they can go any lower than 18 cents per pound for a prolonged period of time. On the coffee front, we will see a drop in the Brazilian crop next year, but as we only anticipate a drop of 2 million bags and very good production elsewhere in Latin America, we are maintaining a bearish view, expecting Arabica prices to decline towards 150 cents per pound by late 2017.
So, while the Arabica coffee outlook is bearish, Robusta coffee as well as sugar prices are expected to remain supported by another global deficit and are therefore seen only marginally bearish. Soybean prices in 2017 will remain vulnerable to weather-related issues. But for grains, like wheat and corn, very large stocks will continue to weigh on prices. Even so, we see the global inventory building coming to an end in 2017. If you'd like to know more about our views for 2017, please download our latest Outlook report or get in touch with your Rabobank representative.